All right, this is another interesting one. This is crude oil. I do believe this is from the 9th. This is like, no, this is from the 11th, I do believe. No, this is the 9th. Okay, this is 3-4 days ago. But it's going to illustrate what we're talking about. Okay. Now, crude has been under pressure for a while. And I didn't put any Fibonacci levels into this one. But this is a long-term chart. This is going all the way back to 2011. This is when the last highs were. You see the last highs that we had. The last highs we had were back in 2011 to like 2000. They say like 13. When they were over $100 a barrel. And this is significant because this is where the frackers make their money. I think the frackers' loans start to lose money. I think they said right around $65 a barrel. So right here is where the fracking was really making a whole lot of money, to where the banks loaned the frackers a whole lot of money to actually produce oil, because oil was very, very high. Which, remember back in 2007, 2008, the Saudis said that when you adjust for inflation, $120 a barrel is fairly priced. So back then, this was the fair price. Between $110 and $120 a barrel was a fair price. You see, it ranged from this to that. So it was ranging from like $80 to like $120, which is a fair range, right? And then you start to have a glut because China stopped buying. So this is where the glut happened, and China stopped buying. That dropped the price down to right around the $65, $70 range, and basically it pretty much stayed there, broke down. And then you got to remember, China is the biggest buyer of oil. So they basically set the price. So when China started going through its events, all of a sudden they stopped buying. This is where you got this. Like I said, you got the head and shoulders. You can see the head and shoulders right there. You see the long-term support, sideways support, and then the neck. And guess what it did? It broke through that. It broke through that right here. It tried to maintain the last vestiges of support right here. Right there. And then it broke down again, which is where we are. Trying to find another support line right here, which is its lows. $25 a barrel. Now at $25 a barrel, the Saudis start losing money when you adjust for inflation. That's like when it came down to here, it bounced back up. The Saudis would normally stop pumping oil. Right here is where they try to get with the Russians to actually stop producing oil and stop flooding the oil market, and the Russians refused. Now, where the Saudis and the Russians will probably lose money, and I do believe it's since gained its footing when it went down to $25, but I think it gains its footing. I think it's right around the mid-30s again. But the thing is, China's not buying. You know, when I think I told everybody a couple of months ago that China's not buying. And when China's not buying, then then the price goes to almost nothing. And you had tankers backed up all the way back to the Middle East because China wasn't allowing anything in. Their economy shut down. So they had no place to put the oil, so the oil backed up. So like I said, normally right in here the producers would start shutting down wells and stop producing, so that the price would stabilize right along, somewhere in here, which it should have stabilized right around the $40 range, but it did not. And when they couldn't come to an agreement, they said, to hell with it. We're going to try to sell the oil as cheaply as possible. Then you have a price war, which you got here. I think since then it's kind of stabilized a little bit. They stopped producing, but like I said, the future will tell us what's going to happen. All right, here's another interesting oil chart, and I actually put the Fibonacci price levels into it. Normally, let me just really briefly explain it. Normally, the red down here is basically the pink, or the reddish is basically oversold, okay? And then it's a gradient all the way to top. But the closer you get to this, that means it gets closer to being overbought. Up here is probably overbought or at peak. So at peak, it's either going to go sideways, and you see the tops either going to go sideways, unless it's something really significant where it breaks out of that and starts basically a whole new level. Either going to go sideways, or it's going to go back down into the ordinary levels, like between the blue and the yellow. And each one of these lines or price levels or Fibonacci percentage levels that will actually signify support and resistance. And you'd have to look up Fibonacci. I'm not going to explain it here. But the reason that is significant is because down here where we have it breaking through the price level right around, what is it, $45 or so, when it's getting into oversold territory. Normally it would get down into here, and you would expect a rally to start somewhere within a couple of months or so, because this is basically the low point. You would actually start buying in here. You'd actually start, when it breaks through here, you actually wait for it to stabilize, and then you start looking for something like this, which is a double bottom, which you got in 2016, and it started to rally all the way back up, right? Back all the way up to $70. You would actually normally look for something like this to rally back up. So the past is the predictor of the present. What you had is basically a slow wind down of oversupply, and eventually what you had is a stabilization. But the thing is, since China's not buying, guess what you got pushed down into? You got pushed down into oversold. Now, any other time, I would say you would look for a bottom. Like I said, now you would actually start buying right in here. This would actually be a good spot to buy in any other market. But since China's not buying, I wouldn't suggest it. I would wait. Eventually, China's going to get back to work, right? Eventually, China's going to have to start accepting oil in. They're going to have to start the factories back up. Otherwise, this market is dead, and then we have bigger fish to fry. We have other things that we got to worry about. But for right now, I would say that as far as oil, I think oil has probably gotten about as low as they're going to allow it to go. If it goes any lower, we got issues. But you can see the limit down and the waterfall that happened in oil. And I do believe, if I'm not mistaken, they got back up into the 30s. So, in other words, they bounced off of this. It might go back and retest this line here. It might go back and retest this line here. It probably will. You might, just like back here, you got a double bottom. You might see a double bottom there again. If China gets back to work, this is probably a good time to buy if you're interested in buying oil and oil futures. If I was playing it, that's probably what I would look for, because this is way oversold. Down here, according to Fibonacci, is way oversold, and this is where you would look to buy. But the thing is that it's a testament to the power of the Chinese manufacturing sector. That when they're not buying, this is pretty unprecedented. Where basically the price of oil just dropped off the shelf from from the 60s all the way down to, to the 20s. That's, you never see a price drop like that. You never see a limit down like that. Especially in oil. Oil hardly ever moves like that unless there's a crisis. So we're looking at crisis level stuff. So, but that's what I wanted to show you. This is just another chart, another indicator. I said a couple of months ago that, about a month ago, that if China's not buying and China wasn't accepting anything to port, oil is going to be the first thing you see as a shock, which actually happened. And then basically the market started to follow suit right after oil did its thing. I had one more chart to show you guys, and then we're going to close this bad boy out. All right. This is, I do believe this is a gold chart from a week ago. This is March 7th, I think it's a gold chart. And since I have metal traders that are interested in gold and whatnot, in fact, there's one guy I follow, Rethinking the Dollar, who dabbles in gold and silver. Silver's in a rut right now. I might do another silver chart later on. But gold has been in a rally for the last year and a half. And you can see the upward trend chart right there. And this is the upward rally. I put in the Fibonacci levels, retracement levels, and I'm liking the Fibonacci. I didn't appreciate the Fibonacci when I was younger. Fibonacci was a little harder to do when I was younger. It's a little easier now. But the upward trend, and it's actually ascending through the Fibonacci level. You can actually see how the natural support and resistance levels of the Fibonacci are actually, the chart is actually adhering to it. I think a lot of that is because you have a lot of bots that look at these charts and then trade on it. So whereas humans are a little bit more unpredictable, the bots are a little bit more predictable. And they, for whatever reason, they love the Fibonacci retracement levels. But you can see it finds support here, finds resistance here, it goes up through it, and then it starts another little mini rally up here, and you see the resistance up here. So right now it's adhering to the Fibonacci resistance level right there. So gold, I do believe, will go sideways. Dollar will probably would disagree with that gold is gonna come down, but I think gold will stay between here and here. That would be my estimation, but that's a pretty good range. A lot of people thought it was actually going to blow through, and some people did actually going to blow through and go back up to its up to its next level, which is right around $1,900 an ounce. That might not be the case. I think there was a couple days where it did peak up in here, and it looked like it might ascend back up to the $1,900 level, right around the 1917 level, which is what my Fibonacci says, which is not oversold, but it's actually pretty reasonable. It's in the gray area. It's not quite in the pink or the red, so it's not in the overbought area, but that is the next level up. And when the flight to safety happens, normally it either goes to the dollar or goes to gold. And recently the dollar's been taking a hit, so it's been going to gold. Dollar will, I know you're going to disagree with me on this, but I do believe that that gold is going to stabilize. Gold is probably already going to stabilize. You think that it's going to take a hit, and it might go down. It might go down. It might stay within this Fibonacci range right here, which is between 1,700 and what is it, the 1,500. So that's a fairly wide range, $200 range. But if Fibonacci, if the gold is going to go sideways, I think it's going to stay within this blue range right here. A lot of people think it's going to break out. If things break bad, it's going to break up here. If it breaks up here and holds, or above the, like they say, the 1720 level, I think that it probably will go to the 1900. So gold might be a buy. But the thing is, in this market, it's unpredictable. Let's look at the next chart real quick. Now, for a second, for a second, gold did break out. And this is when they announced that gold might, you know, when the virus hit, the virus news actually really got entrenched. That's where you got a sideways double bottom and a big push to the upside, where people are buying massive amounts of gold, probably because they needed to get liquidity and get out of whatever currency they were in. So gold is the first place they send their money for safekeeping. So you have this big, massive movement in gold, which is probably why your gold bugs thought that gold was going to go up to the $1,900 level, because it broke through a new Fibonacci support level or resistance level. And it actually did it twice. It went up, broke through, came back down because it was a little bit oversold, and broke through again, which is probably a pretty good sign. This is your coronavirus right here. This is your flight to safety, which is probably why your gold bugs thought that it was going to go to $1,900 an ounce, because crude had been oversold and your stock market's taking a hit. So basically you need someplace to park your money outside the stock market. You need to take your profits and run. And normally you need a safe haven. Normally, like that, in this day and age, it's either the dollar or it's either gold. It's one or the other. This is the latest one I had. What day is this? This was the 10th. And I think there's a new one. I might put that one out. This is a 10th where the gold was trying to hold. It's trying to establish itself sideways at this Fibonacci support range. But I think the latest one says it didn't hold. I don't believe I have a gold for this one. But the thing is, it's still on its upward trend. So even if it came down below that, it would have to hold above right around 1650 to keep its same upward trend. It's pretty aggressive upward trend. But the thing is, I think it will hit its support somewhere around in here, and I think it's going to actually go sideways. So, but I think at this point it's a little bit overbought, because it has a little red bar coming back down. So that means it's a sell day. So people are probably taking their profits. But I think it should hold in this range. We'll see. If it's going to sink back, then it shouldn't go any further down than here, which is right around the $1,500 level. But I do believe that if it's a flight to safety like I think it is, it should hold. Right now, the Chinese are not really buying gold because they ain't got no money, because nothing's going on. Everything that's like a Bitcoin crash is because the Chinese are the biggest users of Bitcoin, and they're not using it because there's no economic activity. Then it'll crash. But gold is normally a flight to safety, and Chinese are one of the biggest buyers of gold, which is probably what's happening with the Chinese trying to yuan trying to probably hitting the skids. They're probably trying to invest their money into gold, probably all over the world trying to invest their money into gold to actually get past some of this uncertainty until some of this blood in the water kind of cleans up, and then they'll sell the gold off. You're going to see a sell off in gold when they try to buy up these assets with the gold. But we'll see. See if I have another chart. Head back down. Got one more. I do have one more. This is the latest one that I have. And this is you see, this is very interesting pattern. This is actually a very interesting pattern, where you see it's where it's actually starting to form triangles. We used to look for these breakout triangles. We used to use these a lot of times. See, a slight sideways move, even a downward movement, and it forms a triangle with your support. And then when you get to the corner of the triangle right here, you see where it's going to break up or down. If it breaks up, then the trend is up. If it breaks down, the trend is it's a failed rally, and you're going to get a downward move. And gold for the last, I would say, 6 months have been doing this pattern where it gets a sideways triangle with a little support, and then it'll get a breakout. So if past performance is an indicator, I didn't look at it today, but it's forming another mini triangle, and it's doing two things: trying to form another mini triangle, trying to get a move up, but it's also trying to hold this new Fibonacci level. And I do believe Dollar Will said it went to the downside. I don't know if it gapped down or not. I have to look at it, but that is the pattern. Gold actually looks good, but gold actually looks good in this particular arena. So gold has been fairly strong for the last, year and a half. A nice big uptrend. And this is probably why they said that the move to gold will possibly be to 1900. And that's the last gold chart that I have. So last chart for the day that I have. I think I spent enough time on this. So with that, I hope this is interesting. Yeah, I hope you learned a few things about Fibonacci. I hope you learned a couple of new patterns. I don't know if I'm gonna make these charts available or not. I might put the pictures up someplace where you guys can actually see them and preview them or peruse them at your own leisure. I don't really trade anymore. But the thing is, when something happens, I like to dust off my old trader's hat and look at these charts like I used to. I'm sure Dollar will weigh in at some point about his opinion. I think Dollar Will's a bigger bear than I am. I'm fairly neutral. You make more money being bearish than you do money quicker being bearish than you do being bullish. But I'm fairly neutral. I'll take I tend to like bull markets because they're a little safer, a little bit more predictable than bears. But when you see a bear, bears eat. Bears eat meat. So, and bears love raw meat. And so when a bear goes down, you see a bear coming, then it's looking for blood. So if there's blood in the water, there's bloody meat. A bear's going to be there to devour it. Bulls like the slow grass. Okay. So normally when they're slaughtering bulls, the bears are there to actually clean up the blood and eat the bones. Okay. Anyway, that's all I got for today. BGS out. I'll see you guys on the next one. Peace.